Corey Runge,
Here.
Ross Schaefer,
I'm here.
Sean Slauson,
Here.
Glenn Slivers. Glenn, are you with us today? Haley Zaroya.
Here.
That's everyone? Awesome. So before we move on to item number 3, I do want to take a moment and recognize Commissioner Slauson's time with us on the commission. I believe this is his last meeting with us. So I just wanted to say thank you for your time, your expertise, your dedication, and let you know that you will be missed. And turn it over. I think Adriana had something she wanted to say as well.
I wanted to say the same thing.
Sorry, I apologize. We didn't coordinate that.
We did not. Sean, thank you so much for your time. And I know that you haven't been on this for that long, but your impact has been just phenomenal. We appreciate the work that you do with the commission and with other groups within the city. So we appreciate you.
I don't know if you
Yeah,
want to say anything, Sean. You.
Sure. Yeah, thank you. I just really appreciate, all the fellow commissioners and all the housing staff for all the support. Really appreciate that. Appreciate the opportunity to help serve on the committee and wish everyone luck moving forward. Apologize that I have to resign a little bit before my term's over here this fall, but I'm moving out of Flagstaff, so I'm no longer able to keep the seat. So appreciate it, and thanks everyone.
Thanks, Sean. All right, item number 3 on the agenda is our land acknowledgement, and Commissioner Runge has offered graciously to read it, so I'll turn it over to you.
The Housing Commission humbly acknowledges the ancestral homelands of this area's indigenous nations and original stewards. These lands, still inhabited by native descendants, hold mountains sacred to indigenous peoples. We honor them, their legacies, their traditions, and their continued contributions. We celebrate their past, present, and future generations who will forever know this place as home.
Okay, thank you very much. Taking the cheat sheet back for the next one. All right, item number 4 is public comment. At this time, any member of the public may address the commission on any subject within their jurisdiction that is not scheduled before the commission on that day. Due to open meeting laws, the commission cannot discuss or act on items presented during this portion of the agenda. To address the commission on an item that is on the agenda, please wait for the chair to call for public comment at the time the item is heard. Do we have anyone here or on Teams who is interested in doing public comment?
Not that I'm aware of. Okay.
Item number 5A then is approval of minutes. So consideration and approval of minutes for the Housing Commission meeting held on January 25th, 2024. Our action would be to approve the minutes from the January 25th, 2024 Housing Commission meeting as presented, and I'm happy to accept a motion for that.
This is Ross. I'll make a motion.
Are you okay, Karen, making a second?
I can second it, yeah.
Awesome, thank you. Okay, so we have a motion from Commissioner Schaefer and a second from Commissioner Flores. It's really hard to do because I think of you guys in first names always. And any discussion, comments, questions? Okay, all those in favor of approving the minutes, please say aye.
Aye.
Any opposed? And any abstentions? Excellent. Okay, so the minutes pass as presented. Item 6A is to vote for 2 Housing Commission representatives to attend Regional Plan Draft Chapter Review meetings. And we did have 1 volunteer commissioner. Commissioner Denham has volunteered to be one of those commissioners to represent the Housing Commission at the Regional Plan Chapter Review meetings. Is there anyone else who'd like to volunteer? Got Commissioner Runge. Yes, Adriana.
I checked with the city clerk's office and they said a vote is sufficient. And just to be specific for this item, this item is to vote 2 individuals from the Housing Commission to attend as individuals these regional plan update meetings with expertise from the Housing Commission. So that's what it is. We'll have to take a look.
Okay, and then just to clarify, will these folks be like reporting back any updates or what they learn, or is that like an official report back from the regional plan staff members in the future?
The regional plan will come to us for an update later on in the process, but they are going to be going, and if there's anything big happening, I recommend that you bring that back for during item 8, E, I believe. If there's anything that we should know as the Housing Commission, we should report.
Okay. Excellent. Any other folks volunteering? Okay, so right now we've got Commissioner Runge and Commissioner Denham, who are volunteers to be our Housing Commission representatives. Is there anyone who would like to, it's a motion then to vote on that, right?
It's just a vote.
Oh, okay. All right. So then all those in favor of Commissioner Runge and Commissioner Denham being our representatives at the regional plan draft chapter review meetings, please say aye. Aye.
Aye.
Aye.
Any nays? All righty. Okay, that passes. Thank you so much, Commissioner Runge and Denham, for sharing your time and expertise for the regional plan draft chapter review meetings. I have to read that every time because that's the whole thing to say. Okay, then action and discussion item 6B is overview and discussion of Flagstaff home buying market and bond funded home buyer assistance program. We will receive an overview of the Flagstaff home buying market and discuss possible options for the bond funded home buyer assistance program. And it's my understanding, I turn it over to Adriana first.
Thank you, Chair. So this item in particular is going to be an ongoing topic from the last Housing Commission meeting. If you were absent at that meeting, we had a brainstorming session of what we could do with the bond funds that were assigned for homeowner assistance. We have in that pot of money, $7 million to utilize. So this is going to be a continuation of the brainstorming with 3 presentations to be presented by 3 local professionals in the market, in the Flagstaff market, to give us an overview of what that looks like. We're going to start today with Karen Flores. She's a local lender. We're going to continue with Karen, we're first, right? Mm-hmm. Okay, and then we're going to continue with Gary Nelson, who is a local realtor broker in the community. And then we're going to wrap it up with our very own chair, Devonna McLaughlin, who is the only housing counselor in Northern Arizona, right?
Counseling agency,
yes. And then just to clarify, no decisions will be made today. This is going to be a topic to receive the information. We're going to get a general understanding of the Flagstaff home buying market. Let's see. We're going to explore options for what to do with this $7 million, but those options have to be assessed for feasibility and legality. And they, of course, the Housing Commission will stay in the loop. So we need to get through all 3 presentations today. So if you get that started for us, we'll get you set up. There's a podium right there if you're comfortable doing that. And then I will get you. Can everybody on see the presentation? Yeah, wait. Can you see it through the through Teams?
No, you need to share it through the call. There you go.
They can switch stuff, the remote for me.
Well, I will try and make this short and sweet, because I could talk all day long about all of this and really crap out of you. And get real technical, but I don't want to do that. And are you okay if they have questions, just interrupt me as we go through, or do you want them to wait till the end?
Absolutely, but try to limit those for the end, just because we do have to get through 3 presentations with hopefully some time for discussion.
Perfect. All right. So here's kind of the things that we're going to talk about. We're going to go over the mortgage process and talk about how interest rates work and what their impact is on what someone can qualify for. Then we're going to discuss where rates are now, where they're going to potentially go in the future, and then what challenges do we as lenders see about buyers facing not only now, but in the future, especially specific to our Flagstaff market. So a little bit about me. I have been in the mortgage industry 27 long years. I started my career down in the Valley, moved up to Flagstaff in 1996. And I have been all of this time a loan officer, but I have also been a branch mortgage manager for about 8 years. I also did mortgage training for one of the companies I worked for and went all over the country training people on different products and programs. I am a current committee member on the Board of Real Estate on their advocacy committee, but I've also been on other different committees that they have. I am also a past board member for the Association of Realtors. And I am currently and have been for a very long time, HAP committee member on Housing Solutions of Northern Arizona, working with Devonna and her team primarily to approve people who request down payment assistance. So that is just a little bit about me. The overview of the mortgage process. A buyer needs to get pre-qualified before they can go out and make an offer on a home. And that is actually something unique to Arizona. It is something that they changed, I want to say it was back in about 2010, where they actually added a pre-qualification form into the contract. And when a buyer goes to make an offer on a home, if that pre-qualification letter is not attached to it, signed by a lender, the seller does not even have to look at it. They don't even have to accept it. So I think that makes common sense why we would have to have this. We should always have to have somebody pre-qualified, because I mean, I can't imagine as a buyer going out and looking at homes, not even having a clue if I can afford it. And I hate to get my heart set on something that I couldn't even qualify for. So it does, I think, give a huge advantage to everybody within the transaction, especially the buyer, because they know how to go out and search for homes. Once they do get pre-qualified, again, they go out and shop with a realtor. Once they have an accepted offer, then we can start our formal loan process. And then once that process is complete, we can close, they can move into their home, and everybody is happy. So here's just a brief overview of the pre-qualification process. As I mentioned, it just helps a buyer determine what can they afford. What loan programs can they qualify for? Because based on their personal situation, they may only qualify for one program, or they might qualify for all programs that we have. And then it also helps them determine what properties they can qualify for, because there are certain products and programs where maybe based on their loan program or their credit score, they may not be able to qualify for certain properties. An example would be a manufactured home, a condo, things like that. So we want to make sure when that realtor goes out with them, they are looking at the right properties as well as the correct amounts that they can afford. What we ask for when we do a pre-qualification are these following items. We want to see if they're a W-2 employee. We want to see their check stubs for the last month. If they have any income reported on tax returns, we want 2 years worth of that. Assets, we want to see 1 to 2 months to see, do they have any money that they can contribute to the down payment and closing costs? We ask for a photo ID, and then we are going to do a credit check. So in order to do that, I've got to know what their name is, their address, social security number, and date of birth. The first thing we're going to look at is their credit. Credit is absolutely the most important part of the pre-qualification. Because if they don't have the minimum credit score requirements, there's no way we can even get them qualified. So what we as lenders look at is a tri-merge credit report. That means we pull from all 3 credit bureaus. We can't just pull from one, we have to look at all 3 because some creditors don't report to all of them. What I know I do is I do what's called a soft pull when we're at the pre-qual stage, because we don't want to impact their credit score and should have inquiry show up initially. Once we do have a property and a contract, that's when we're going to do the actual hard pull. So we're going to look at their scores, what kind of accounts they have, do they have any late payments, collections, judgments, things that might pose a problem with us getting them qualified. We look at joint and individual debts. One thing we run into a lot is buyers co-sign for other people for car loans and things like that. Well, if we can prove that other person is making those payments, and they have for 12 months, we don't have to hit them with that payment. So there's a lot of things that we look at on the credit report. Just for an example of what the different scores are that we see and how that impacts our qualifying. If anyone has a score 740 or more, they have excellent credit. They're going to qualify for any product or program that's out there. Anywhere from 739 to 680 to 739, still great credit. Shouldn't have any problem qualifying for any loans. Once you go under 680, then we do run into sometimes some challenges with different loan programs or options. Some programs have minimum credit scores if it's a manufactured home. Sometimes we can't get a loan approved if they're under a 680, if it's a manufactured home or a condo, especially if they're just putting minimal amounts down. So if you get under that 640 score, then it even becomes more difficult, especially with minimal amounts down. So credit scores are definitely important. If someone doesn't have a credit score that's going to allow them to qualify for what they need or want now, we do have the ability to work with them to help them get that score up. Sometimes it's super simple and they just maybe need to pay off a credit card. Maybe they need to open a credit card. Other times it's really a bigger process, and we do have credit repair agencies that we work with and can have them help them get where they need to be. Again, sometimes it just takes a few months. I have other folks it takes years because they may have really severe credit situations. But we do try to work with everyone to try to get them mortgage ready. The next big component is income, because obviously you've got to be able to repay the loan. So we want to see how they're paid. Are they salaried, hourly, commission, self-employed? Salary buyers are the easiest because that's a guaranteed amount they're going to make consistently every 2 weeks, every month, however that is. Where we run into challenges are hourly, commission, or self-employed buyers because their income varies. And so it becomes a much more difficult and sometimes not even possible to get them qualified because their income may fluctuate. A great example of that is self-employment. So self-employment income is reported on a tax return. And how many of you file tax returns and want to pay the government as much money as you can? No one? Okay, well, that's what self-employment, or folks that are self-employed, they don't want to pay. And they write off a ton on their tax returns. So when they do that, we as a lender have to look at what's that bottom line after all those deductions. And a lot of times you've got someone who maybe they make $1 million a year, but by the time you look at the bottom line, they make $25,000 a year. Well, that makes it very difficult. And so sometimes we have to get creative, look at non-traditional types of programs to help them get qualified. Again, we want to know, is their income stable? Is it consistent? Do they have a 2-year work and school history? So someone who's been in school, but now they're working, we can use that school history, whether it was high school or college, trade school, that can count as a work history because they're preparing themselves for the job world. Debt to income. So now that we know kind of what their credit situation is, what their debts look like, how much their monthly payments are, and we know what their income is, now we have to back into what can they qualify for. And we have specific requirements for each program as to what their maximum debt to income ratios can be. So there's two ratios. One is a housing and one is a total debt ratio. So the housing ratio is we take their new payment for the house that they're buying, we divide it by their gross monthly income and we get a ratio. For the total debt to income, obviously we take the house payment and all other credit cards, car loans, student loans, and divide it by their total gross monthly income, and we get those ratios. And I'll go over kind of what those are, what those limits are per program here in just a second. What makes up a monthly payment? Obviously, the principal and interest for that loan, the property taxes. If there is an HOA, we have to add the HOA fee in. So townhouses, condos, sometimes neighborhoods have HOAs that we have to consider. Homeowners insurance, and then private mortgage insurance. So on any loan where someone puts less than 20% down, and most of our government loans, they all already have mandatory mortgage insurance. So that amount is part of that monthly payment and has to be taken into consideration. Assets. So definitely we want to know, does the buyer have any money that they can bring in for closing costs, down payment, all of that? So we have them bring in, those accounts if they have them. We can use checking accounts, savings accounts, investment accounts, retirement accounts. A lot of people don't realize that if they have a 401k, they can borrow from it, and we don't count that payment against them. And so that's a lot of times a huge component when we're qualifying someone, because they think they don't have any money, and then I find out they have a 401k, and then boom, hey, we have a solution. So the other options they have is maybe a family member can help them. They can provide a gift, and gifts are allowed if it's a family member, someone who has a family relationship, brother, sister, uncle, cousin. It could be a fiance, things like that. It can't be the cross the street neighbor or your best friend. But another thing that people don't realize is we can actually get gifts from employers. So I've had numerous situations where someone's employer agreed to provide gift funds for them to use towards their down payment or closing costs. So there are ways we can get creative. Another thing is people can sell something. They can sell a car. I know this is going to sound corny, but when I first got into business, someone sold their cow. And because it's an asset, we can document that they had the asset. We can document what it was worth, and then we can document they received the money. They can also take loans against assets. So a car, anything, technically, if they're not a first-time home buyer, they can borrow against another house. So there's ways we can come up with it. And then last but not least, down payment assistance. We always look at that if that's something the buyer is eligible for and they just don't have any other resources.
Is there a limit on the gift money?
So there is, it's based, actually I should say no. There is no limit on the gift money. I'm thinking of closing costs. So no limit on gift money. We have members gift. I just had one where they gifted $150,000 to help out. Another thing that I really did bring up here is a lot of times family or friends, whomever, can co-sign to help get somebody where they can be to be able to qualify. These are the 4 different main loan programs that are out there. So conventional loan is basically a private company type of loan, meaning the Fannie Mae and Freddie Mac, which you may have all heard of, they are the ones whose guidelines we follow. They are private companies versus FHA, USDA, and VA are all government-backed loans. USDA, we are obviously not going to talk about that because that's for properties that are outside city limits. So it would not apply for anyone with our purposes for the bond money. But conventional FHA, VA can all be used, whether it's in the city, if it's rural, etc. I'm gonna focus this all on first-time home buyers. And so on a conventional loan, if you are a first-time home buyer, which is defined as someone who has not owned a home in the last 3 years, you can put as little as 3% down. The only caveat to that is if the home is a manufactured home, the requirement is 5% down. Minimum credit score on conventional loans is 620. Conventional loans have a max loan amount of 766,200. That amount changes every single year. That amount's based on a national average of what home prices are. And if home prices go down, that number goes down, and it has gone down in the past, but in most recent years, obviously, we've seen that number continually increase. On a conventional loan, the maximum debt to income ratio allowed is a 50-50 ratio. So 50% housing payment, 50% total debt ratio. Sellers, if they're buyers putting 3 to 5% down, the maximum a seller can help out with closing costs only, the seller cannot cover any down payment, is 3% of the purchase price. FHA, 3.5% down, regardless of what kind of property it is. Minimum credit score 600. FHA has maximum loan amounts based on the county. So Coconino County maximum amount is 525, 550. Their debt to income ratios cap out at 46/56. Sellers can cover up to 6% concessions. Then VA, if anyone is eligible for a VA loan, whether they're currently in the military or a veteran, they can come in with nothing down. So VA, if someone's eligible for it, is always a great option and one of the best options out of all of these programs. Minimum credit score 600. There is no max loan amount anymore. They used to follow the conventional loan amounts, and then a couple years ago, they decided to drop that, and there is no max loan amount. However, once you get over $1 million, there are some variables, but I don't think most of our first-time home buyers are going to be worried about that piece of it. The maximum debt to income varies, and I have seen debt to income ratios in the 60s and even almost at 70%. The way FBA looks at qualification is they want to see residual income and how much income does somebody have after we take into consideration all of their debt. And so if they have residual income left, then they will allow us to go that high in debt to income ratios. And the seller can cover 4% in closing costs on this. Closing costs. Closing costs run about 2 to 5% of the purchase price. And the reason that's such a wide percentage difference is because some of the costs are fixed. So for instance, our lender costs, our processing, underwriting, and credit report fees are always the same, regardless if you're borrowing $100,000 or $2 million. Those things are fixed. There's some other lender fees that are fixed as well, but the appraisal depends on property value, location, type of property. Homeowners insurance obviously depends on a lot of those factors. And then title company fees are based on loan amount, purchase price. So they can widely vary. The other thing that I didn't put on here, but there can be closing costs for interest rates. So if someone doesn't have the world's greatest credit, and based on the products and program that we're looking at, there may be a cost to get an interest rate. And those are called points. Points normally are used to buy the rate down, but they also are sometimes just required because there is maybe no rate available that doesn't have points. And we see that a lot right now, especially since rates are so elevated. And I don't want to bore you with why, but that is just a function of the increase in rates that we have right now. We have to cover that cost and because rates are so high. The seller can help cover that, but regardless, there are points sometimes associated with the rate. This is an overview of the process once we have a contract. So we've already gotten pre-qualified. Once we've got that contract, then we are going to start either updating or gathering any borrower documents that we don't have. Then on our end, we are doing a ton of checks. We are checking to make sure that the income is what we're being told and given. We actually verify with the IRS that the W-2s and tax returns we receive are what were filed with the IRS and they're not manufactured, because that does happen. We also verify with the Social Security Administration that this person's Social Security number really is their Social Security number. And there's a lot of other checks that we do throughout the process. We also require an appraisal in most cases, and the appraisal is literally to determine value. It does not determine whether the water heater works or some of the other things in the home are, functioning. That's what a home inspection is for. We don't require a home inspection for the lending process. We only require an appraisal. So agents usually suggest to their buyers, get a home inspection so you can make sure there's no underlying issues that aren't seen readily through an appraiser. Then once we have the appraisal and the basic documentation, we send the loan to the underwriter. And one thing that I didn't share is when we qualify someone, we put all of their information into a computer program, and then we run that scenario through an automated underwriting system. So each loan type has their own automated underwriting system, and it comes back and says, yes, your loan's approved, or no, it's not. And usually it'll tell us why it's not approved. Sometimes it's credit score, sometimes they don't have enough money down because credit score isn't, let's say someone has a lower credit score and they're only putting the minimum down. Well, it may not, they may have really great debt to income ratios, but the system comes back and says, we don't like it. It's too risky. If they put more down, we might be able to get them approved. Again, we are so reliant, unfortunately, on these computer approvals that in most cases we can't turn around and say, sorry, this makes sense. We have to go off what the decision is from the automated approval systems. The underwriter's job is to double check that A, everything that's in the system matches all the documentation, and B, things that the system can't see meet requirements. So we look at bank statements. We would literally go line by line through bank statements to see, are there any unusual deposits that aren't regular payroll deposits? If so, we want to know what it is. We have to get it documented because we want to make sure that they're not borrowing money from another source that we're not counting a debt for, or did they buy another or sell a property or something? We need to document where funds come from, unusual deposits. So that's one example of what an underwriter is looking at. They're also looking at pieces of information on the property itself that, again, a computer can't analyze things like that. Once the underwriter reviews everything and everything looks great, they issue an underwriting approval. There may be other things we need to get based on that underwriting review. We go back and get all of those things from whomever we need them from, whether it's the buyer, the appraiser, etc. And then when we have everything we need, we go back and get what's called final loan approval. The same underwriter goes back and makes sure everything is good. And if everything's great, they issue what's called clear to close. That means we can move into closing, get those closing documents prepared, send them to the escrow company where the buyer can then go bring the rest of their funds, sign the closing papers, get their keys and move in. So that's what we go through during the formal process.
Karen? So appraisers, I've heard, with VA and FHA, they're a little more stringent conditions of the property, but I've also heard conventional are going that way a little more too. What's your opinion on this? Like, are they writing up conditions similar to the FHA and VA?
Similar, FHA and VA, they're very, all of them are concerned with health and safety issues.
Yeah.
So like I just had a conventional loan recently where there were some broken windows or cracks in windows. That's a safety issue. So those things would have to be fixed. The government loans, they'll look at more things. I mean, for example, FHA has this requirement that if there's any wood on an outbuilding, on a deck, anywhere on the property, it has to either be treated or painted. And if it's not, that has to be done. So they're more picky on stuff like that versus conventional probably wouldn't require something like that, but definitely health and safety issues across the board. Any other questions on that? All right. Now to the fun part, interest rates. And interest rates are more complex than people think. I know we all hear on the news, oh my God, the rates are going up. Oh my God. They're supposed to reduce them in March. Oh, they might do this, they might do that. A lot of what you're hearing about on the news is the Fed funds rate, the short-term rate, the rate that is impacting your credit cards, your car loans, your depository accounts, your checking and savings accounts, CDs, things like that. Those are all controlled or governed by the Fed funds rate. The Fed funds rate is the rate at which banks borrow money from the central bank of the government. And back in, I don't know if it was 2008, 2010, somewhere in there, most of us, I think, remember the market crashed, we had a big recession, and the feds reduced the borrowing rate for banks to 0. And it remained at 0 up until November of 2022. So I'm sure many of us took advantage of 0 interest credit cards, 0 interest car loans, things like that. We all realized that our checking and savings accounts and CDs didn't make any money because there's no money to make if we're at a 0% interest rate. So this particular rate does not have anything to do with mortgage rates directly. It has everything to do with these types of things directly. However, the Fed funds rate can impact mortgage rates. And so let's talk about how the mortgage rates work. The mortgage rates are determined by the bond market. So what I explain to people, the bond market is kind of like the stock market. Stock market trades stocks for businesses. The bond market trades bonds for mortgage bonds, corporate bonds, and treasury bonds. Treasury bonds are owned by the government, backed by the government. The mortgage and corporate bonds obviously are not. But investors, just like they do in the stock market, if they feel something's of good value, they invest in it. If they feel it's not, they pull out and don't invest in it. And that's what drives mortgage rates up and down, is depending on various factors within the market, whether they want to put their money in the bond market or mortgages, treasury bonds, etc. So to give you a little bit more detail, a mortgage bond is a collection of mortgages, and they're wrapped together and known as mortgage-backed securities. So when lenders close loans, they then package a bunch of loans, and then they sell them on the secondary market, and then that's when people invest in them. They're a package of loans. They could be hundreds of loans, they could be thousands of loans, but that's how all of that piece works. However, mortgage rates can be impacted and influenced by the Fed funds rate. And a prime example of that is what we're going through right now. I think we all realize we're dealing with inflation and have been. And inflation was caused from a couple of different factors, but the definition of inflation is too many dollars chasing too few goods. So with the Fed funds rate at 0 for so long, then we run into a pandemic. And then we have people getting money from the government. And then we have interest rates on mortgages going down into the tubes, which, by the way, was all because our government purchased mortgage-backed securities and created that lower rate.
PC connected.
No. Oh, okay. Created that false situation, I guess I should say. It was a manufactured rate environment. It was not caused by natural economic conditions and factors. So obviously people would not were not stupid and obviously took advantage of the fact that rates were so low and so great. But as we all know, during the pandemic, people spent money like crazy and we had a supply chain shortage. And so again, because there were shortages and people were trying to buy and buy and buy and buy, it drove prices up like crazy. So what is the role then of the feds? They have to slow that down. Otherwise, inflation gets out of control. Everything becomes so expensive. So that's why they started raising the Fed funds rate. And they raise it in increments of a quarter. So you would see sometimes when they would meet, they would raise it a quarter, they'd raise it 0.5%, they'd raise it 1%. Again, all trying to slow the economy down, get people to stop spending, which they have done a great job of doing that because our economy is slowing. Inflation is coming down. Another thing that impacts rates is a recession. So a recession obviously is the opposite of inflation. Things slow. There's less job growth, more unemployment, things like that. Mortgage rates, if they follow both of these. So they go up with inflation, they come down in a recession, or if inflation goes down, mortgage rates go down. You don't have to have a recession for that. The other thing that drives mortgage rates on a daily basis are various reports that come out. So every single month, there can be anywhere from 50 to 80-ish reports that come out. And based on what these reports, does that mean? Based on these reports, it can be market moving in a good way and market moving in a bad way. So some of these reports are employment, which obviously unemployment or job growth, layoffs, things like that. Housing, how many housing starts are there? Building permits. There's tons of reports about housing. How many mortgage applications in a given week? Every single week they report on mortgage applications. Manufacturing and shipping. Are companies making more things and shipping more things, or are they pulling back? Consumer price index and personal consumption. What are people doing? Are they buying? Are they not? Same thing with retail sales. In December, retail sales were up, which gave, of course it's Christmas, but the government thought, well, people aren't going to buy as much because they don't have as much money. Well, unfortunately, the reports came out saying, no, sales were actually great. But what we also found out is people using the credit cards to do all of it. It wasn't discretionary cash. Consumer confidence, which surprisingly they say is high right now. And then other countries around the world also impact what our rates do. Many countries have very similar economic, they have their stock markets, they have their central banks, things like that. And so based on what they do or things that happen within those countries also can impact our rates because we are an international world. We're global markets. We all buy, sell, trade, all those things globally. The last piece is credit quality and risk of default, and that can go directly down to a buyer's specific loan assessment. So based on their strength, their credit score, their debt to income ratios, how much they put down, all of that can also impact rates. And so I get calls and people say, well, what's today's rate? And they get frustrated when I say, I don't know. Tell me more about your situation. Rates are not the same for everybody, and they're not the same for every situation. So we can have the same property with the same purchase price, and we've got Devonna, Eric, and I'm sorry, sir, what's your name? Kevin, okay. Kevin, who are all trying to purchase that same home. And all three of you have totally different credit scores. Maybe all three of you are buying it as a primary residence, but all three of you are putting different amounts down. So because of all of that, you might have a rate of 7.25, yours might be 8, and yours might be 6.75. Thanks for being the lowest. You're welcome. So again, it's all individual based on you, your situation, and the property that we're dealing with, and the loan program. So those are other things that drive mortgage rates. As I mentioned, inflation is why rates are so high right now. Hopefully that's going to change here soon. And Gary said he's got bets with people that rates are coming down. Well, you don't, you
They
have,
have,
You
they're
think it's
saying the
going
rates are coming down.
okay.
I'm a little, yeah, I'm a little scared.
I
Not too much.
Okay.
Mid-year,
agree.
that's what I think.
So this is what the market experts think of what's gonna happen. So again, this is the Fed funds rate that I was talking about, that the banks borrow money against. But again, they're going to directly impact mortgage rates. So back in January, they came out with this information stating that they felt by June for sure, we would definitely see a cut. There is a chance in May we might. I know I've heard on the news that some people were claiming March. I really can pretty much tell you it's not happening. So what these dates are is the Fed members, there's 12 of them. They all meet on these months and these dates every single year. They meet 9 times, and then they discuss the economy and what they're going to do. So we do feel, again, by June, we're going to see at least a 0.25% rate reduction, potentially higher. And what happens in the mortgage market is based on what they say in prior meetings has an impact in between those timeframes. So back in January, when they said, okay, we're not done cutting, we're done raising the rates, but we think we're gonna cut them soon. Well, then the mortgage rates started getting better. But then some information came out in the last couple of weeks where they said, whoa, pump the brakes, because the media got all excited. And they said, we don't think so. Don't get your hopes up. We're not sure when we're gonna cut rates. So then rates just bumped up in the last few weeks, terribly. So again, there's so many things that one person says one word and all of a sudden everything goes crazy. But this is what we're predicting. Nothing so far that anyone has predicted has happened. They expected rates to go down last June or July, which they didn't. They went up to almost their highest they've been in 20-some years. But should things continue to improve with our economy, they are expecting rates to continue to decline into 2025 and into 2026. There are predictions that they may even get below 5%. Again, we'll see. Nobody knows. Nobody's an expert in so much of this too can be impacted by global things that none of us have control over, like a pandemic or anything. So, knowing all of that, what can someone in Flagstaff afford? Just an average buyer. So I use 70,000 as an average amount, and I'll show you where that number came from after we get through this. But let's say they make 70,000 a year, and this could be a couple, this could be one person, but they don't have any monthly debt, which there are some people that really don't have any debt. And they've got a good credit score of 725. With a conventional loan, if we use their max debt to income of 50%, their mortgage payment has to be less than $29.16. So here is a payment, principal and interest, insurance, taxes, mortgage insurance, that fits right within that. So 370,000 is about the max they're going to qualify for. Now, sometimes that can vary because some homes have higher property taxes than other homes. They might get a more expensive insurance quote than somebody else, but on average, this is about what they're looking at. 3% down, $11,100. If rates go down to 6, bumps them up to 410. If they go down to 5, bumps them up to 450. So rates definitely play a big factor in it. But they do have to reduce significantly for that factor to be huge. Well, most people do have some type of debt. Most people have a car payment or something. So I just use $400 in debt. This is what it does. It takes them from a $370 purchase price to $315. So that's a huge difference. And there's a lot of people with a lot more debt than that. So if they have more than 400, they're down now below a 300 purchase price with 3% down. So Gary will tell you there's probably nothing in town that they can buy if they drop below that. If rates improve, definitely we can improve what they can go to. Well, what about a condo? Everyone's like, I get this all the time. Condos are the least expensive thing on the market. Great, let's go for it. Well, the problem with condos is they have HOA dues. And so I took an average HOA due of $200, and you can see if they have $400 in debt, That HOA just kills them and now they're at that 315. Our lovely teachers and police officers, they're the ones who are taking the biggest brunt of it. If they are trying to qualify for a loan by themselves, whether they're single or with no kids or single parents, and I see them all the time, I know Devonna does too. The sad truth is trying to get them qualified with minimal down payment is pretty much slim to none. In this situation, if they have 400 or no debt, they're looking at a $245,000 purchase price, which they would have to look at a condo if they're going to be within the city limits. And $245,000 on a condo, the other day there are none. The closest to that is about 257. So.
And that would be a studio.
That would be a studio, yes. And that's where I run into issues. I have a mutual client with Devonna where she's got a son. We could probably get her into a studio, but she has a son. He's a teenager. She doesn't want him in a room. He doesn't want to sleep on the couch. So based on all of this, what I've had to come to grips with is there is a segment of our population that if it's just them on their own and no one else can be on the loan with them, they unfortunately are not going to be in a position to buy a home. Not unless we are able to come up with some type of a subsidized property condo complex or something to where these prices are going to be below $250,000. So fortunately, the majority of, I shouldn't say the majority, they don't make up the entire amount of Flagstaff. So there are a lot of people we can still help. And so here's where I got a lot of my information from. So on the right-hand side, you can see the median household income is around 67,000. So that's kind of where I came up with that 70,000 average. And below there, you can see the demographics by age. We have a very large young demographic population from students.
Please see, connect.
And then next to it, homeowners versus renters. The saddest part of this is only 11% of our rental population can afford to buy here. Here's what they're projecting Flagstaff home appreciation to do over the next 5 years. So right now, home values are about $697 at median home prices, excuse me. Again, there's ones that are 400 or 4 million, and there's ones that are 200,000 that all go in that equation, but on an average, 697 is where we're at. Homes will continue to appreciate, and this is kind of what we're looking at over the next 5 years. That's only going to further distance affordability. So what is the biggest roadblock for people that do have the income to qualify? It's cash, it's money, down payment, closing costs. Sometimes it's one or the other, sometimes it's both. So there's down payment assistance options, and Home Plus is one that is a state program. Many states across the country have this same similar program. It does have income limits of 126,000, which is very generous. It follows the loan program's debt to income requirements, which is nice. It can give up to 5% in assistance when rates are lower. Right now, the most I could give somebody on this is an FHA loan with 3% in assistance. And we will see these other options come back as rates do get better. But right now, we don't see that. The negatives to this program is a higher interest rate. They set the rate because they're reusing those funds for the next person that comes along. So it's paying it back. The other negative is fees for this program eat up 2 to 3% of the assistance. So right now, with it being 3% in assistance, it's not even worth it, especially with the higher rate. And then many buyers still need closing cost assistance because you can't get, again, a lot of people don't have either or. There are some programs out there where there are lenders such as ourselves that offer down payment assistance programs. Many of them don't have income limits. Again, they follow the loan program debt to income requirements. They can get a 2 to 3% in assistance. The negative is it is also a higher interest rate to refund it. And again, we still are short funds for that most buyers in these situations. Housing solutions, I'm not even going to talk about because Devonna's going to share that with you. But one of the challenges as a lender or from the lending side is because their assistance has to follow government regulations and requirements. They have restrictive income limits and restrictive debt to income requirements. And so there's many times I can't help somebody because they either make too much, or if they fall in the income limit, the debt to income ratios are so restrictive, they can't qualify for more than, $150,000 based on those requirements. The positive is it goes with the regular mortgage program, so there's no increase to the rate. We're not refunding their program. So what are some past, current, and future challenges? In my personal opinion, I feel there's a lot of things that none of us can control with wages, job options, things like that in our town. Unfortunately, we have a town that wants to stay small, has stayed small, has over the last 30 years remained at a 1% to 2% up and down growth. And part of the restriction is that with that is we haven't brought in higher paying jobs where people can make more money. We're a very retail service industry driven town. So there's a lot of people out there that, yes, we've raised minimum wage, but $17, $20 an hour doesn't buy you a house, even if you've got someone else on the loan with you. Our cost of living is obviously quite high. Some of it's influenced by our current inflation, but some of it's because Flagstaff is an expensive place to live. So with both of those things combined, people can't save money. They can't come up with a down payment, even if they can afford the income to buy. We talked about the limits on the local down payment programs. Another big issue we're facing in this last year is homeowners insurance premiums are skyrocketing, and it has to do with the floods and the fires here. We're finding insurance companies aren't insuring anymore. I've had my insurance canceled already twice in the last 6 months. You as well?
Yeah, me too.
I think a lot of us got that. Yeah. And unfortunately, the higher those premiums are, the higher the payment, and it makes it more difficult to get people qualified. Inventory is low. It will continue to remain low. I know Gary will talk probably a lot about that. To give you a perspective of why it's low, and it's low nationally, because when we went through the recession back in the late 2000s or 2008 and 10, builders went bankrupt. Nobody was buying a new home, so builders stopped building. We went through a time frame of up until about 2016, 2017, where builders were not building. They couldn't build. They couldn't get lines of credit. People that wanted to build custom homes couldn't get construction loans unless they put 50, 60% down. So we didn't keep up with the needs of housing. So because of that piece, we're short homes nationally. On top of that, then we deal with the pandemic and the low rates. People who are in their homes have no, 2-3% rates, don't want to sell their house unless they have to because they have nowhere to go. So inventory is going to continue to remain low. They were predicting a couple of years ago, 3 to 5 years. I think it's 3 to 5 years from now, probably still, could be longer. Rates will eventually come down, and that's going to put a different pressure. Right now, because rates are high, sellers are having a harder time selling homes. They're more willing to negotiate. They may not have a lot of offers. They're willing to cover closing costs just to help get the home sold. When rates come down, they're going to be able to pick whichever offer they want. The one that's the best, the fastest to close, they're not going to pay closing costs. And then we're going to see ourselves back in bidding wars again, where they're going to be able to get over asking price because there will be 3, 4, 10, 20 people bidding on one house. And it's just going to, unfortunately, drive up home values again, which again is going to make it even more difficult to get people qualified. And it's going to, unfortunately, exclude even more people as we have that issue. So with all of that wonderful, great news, those are a lot of things to think about as we talk about what are some ideas to help bridge some of that gap. We can bridge some gaps, but hopefully this will help as a piece of the puzzle to get there.
Is there anything in Congress or anything being talked about limiting the amount of investors and giving more potential chances for first-time home buyers? So like the first right of recession to a first-time home buyer, or make it more expensive for an investor.
So they have made it more expensive because we're, free market. We can't control what people do and how people sell their homes and all of that.
Well, but they could.
They could, but I don't want to live in a society like that.
Well, I'm just saying.
Yeah.
It gets to a point.
It gets to a point, I mean,
It
yeah.
really might have to.
What they have done, they did with a couple of years ago, is they did make it more expensive and a little more difficult for someone to buy a second home in an investment property. They have to put more down. The rates are significantly higher. They have to pay more claims to get that rate. So it has discouraged people.
Yeah.
But, and so we have seen a definite decrease. I think one thing that has helped as well is we're out of the pandemic. People were buying things like crazy because they saw instant opportunity with renting. That's kind of gone to the wayside. We're not seeing that as much. So I think that naturally has helped. But other than that, I think the government.
That one.
Somebody's able to.
Sure, the audio goes off as soon as the realtor.
Sorry.
No, no.
Flagstaff Eye Care. If this is a medical emergency, please hang up and dial 911. We are located at 410 North San Francisco Street, Flagstaff, Arizona 86001. Our normal business hours are 8 a.m. to 5 p.m. Monday through Friday.
Okay. Present super quick. It sounds bad.
Is it on again or not?
It's on again, but it sounds like robots. We can't.
That can be very interesting. When you go, yeah. Hello, can you guys hear us? Oh my gosh, we had a thumbs up. Yay.
Yeah.
Tyler, can you talk to us on mute to see if we can hear you?
Yeah, I can say something. Are you able to hear me?
We can, yes. This seems
Nice.
like a positive change of direction, so yay.
Do we still have a quorum?
We're gonna do a quick quorum check, so if you can still hang on with us for 1 minute.
Sure that we've lost them.
Perfect.
Or just put out for a minute. There it is.
Yeah, but we have 1, 2, 3, 4, 5 here. So yeah, 6, 7, I saw at least, and we needed 7. Okay, so I think we're good to move forward. Is that correct, Steph?
Yes.
Okay, all right. Folks who are virtual, thank you for letting us know you could not hear us. If it happens again, please feel free to put in the chat that that is a disruption, just so we know. Marissa's monitoring that for us, so we appreciate your patience. I am going to turn it over now to Gary Nelson to do an overview of the Flagstaff real estate market. He says it'll be less than 2.5 hours, so it'll be an amazing presentation, I have no doubt.
Yeah, thanks, everybody. It was, oh, there it is. So, this is me, yeah, my contact information, I'll give you that at the end. I think this is why I'm here. I was president of the Association of Realtors, the State Association of Realtors in 2022. I sit on that board still, and also on the National Association of Realtors board, and I'm involved with some committees there as well. My biggest claim to fame is I am a Flagstaff resident. I've been here my entire life. I lie to people and tell them I grew up in a gated community, but that's, you know, out of so, yeah, I actually grew up out in Belmont until I was 10 years old and then moved into town. So I've been here since, spent some time in California, but I've tried to have been involved with community groups as much as possible. And that's how I know Yvonne and others here. So, so I'll move on quickly. I'm going to give you some housing statistics from the national viewpoint. Arizona, just a little bit in Arizona, and talk about median price ranges and then local as much as I can. Was it not being shared? Okay.
Oh,
That was a person.
That's okay. That's all right. Well, I'll pause a minute here. I'll tell you like a dad joke or something. Yes.
How's that look?
Presentation.
Okay. Okay.
Okay, but they can hear me, so we'll just go through that. There it is. Okay. So national, and really what it comes down to, and by the way, everything that Karen told you is absolutely right. Everything there. We'll probably look at some different median numbers when we're talking about Flagstaff, and it's how you define the market is where you get to those numbers. And do you consider the zip codes, or do you consider it inside the city limits? And I would guess that what you gave was inside the city limits, and you never know. But I've got some different statistics and some different things here. So starting off with a couple of quotes. This is Elliot Eisenberg. This is an economist that I follow. If you are interested in housing, have you heard him speak? Okay. He's very animated, very funny, and he does this kind of short blog every day. It's about the size of a tweet, but this is him. While existing home sales are very weak, home prices keep rising. Case-Shiller National Index was up 5.1% year over year in November, up from 4.7% year over year in October. Similarly, the FHFA index saw home prices increase 6.6% year over year in November, up from 6.3% in October. Moreover, single-family mortgage seriously delinquent rate was just 0.55% in November. So this single family mortgage seriously delinquent rate is anybody that would be potentially defaulting on their home. Well below pre-pandemic lows, and at rates last seen late in the housing boom. And then this is another quote from him just about a week and a half ago. While the Fed did lower interest rates after today's meeting, it suggested that cuts are on the way. However, by reiterating that he wants to see continued declines in inflationary pressures before the Fed cuts rates, Powell gave markets no indication that cuts were imminent, and simultaneously has provided the Fed with strategic ambiguity as to when it will start cutting rates. A June cut remains my base case. So we were talking about a little while ago about whether I've got money right now on May 1, and I'm saying no to that. You know, somebody else is saying, yeah, we're going to have rates cut prior to that, and I don't think so, but neither does he. And and this guy right here, by the way, I have never seen him be wrong about anything. So if you're interested in housing, he actually does some really funny little other items as well. So moving on to the housing market, this is information I grabbed from the National Association of Realtors. This is the NAR housing affordability, a payment as a percent of income. And what they'd like to see is that 20% mark. That has been increasing. So housing affordability is just flat out not there. Since July of 2023 is when that number's from. Moving on from there, income of buyers. The interesting thing is, this is very interesting, is that income has actually dramatically increased. Buyers' income has dramatically increased over the last few years. I did see the rate from 2020 on that I saw last November. But this is pretty interesting to see how much household income has increased over the last few years. And that has to do exactly what you were talking about, with an increase of money into the system. Home buyers really actually are making more money, and higher minimum wages lead to higher wages all the way around. Inventory of existing homes. This is also what Karen was talking about, and how much that has decreased. And you can see all the way, this graph goes all the way back to January of 2000 into September of this year. You can see this little seasonal changes. So we have a huge seasonal change here in Flagstaff. We're down in Phoenix is opposite of us. Our season is just getting ready to start. And that typically starts at about mid-March and gets into April. The peak of the real estate market is in Flagstaff is June, and it is nationally as well. So we're a little bit closer to the national trends. Phoenix is the opposite of us. They think that they're their entire state, but they are ours. Average number of offers received on most recent sale. This is piggybacking off what Karen said as well. You can see that huge spike up, that 5.5, that was the 2020, 2021 point where there were multiple offers. But even now, there's an average of about 2.5 offers per property. And these are national statistics. Median down payment on buyers. This is the difference between first-time home buyers and then also repeat buyers. Typically have quite a bit more money, and that's because they are already in the market. They get the foot in the door, and they have equity when they sell and turn around and buy. And you can interrupt me at any point, by the way. I just wanted to move quickly, I guess, through here. All cash buyers trend higher also. So this is not good news for local, because it's actually higher than that. 29% on the national, we'll call it 30% nationally, are cash buyers. And so Karen talked about pressure, and there is constant pressure from second home owners in the Flagstaff area. There's constant pressure from cash buyers. That number's way up in the 30s, upper 30s for local. The share to distressed sales, this is, we do not have distressed properties very much anymore in nationwide or locally. You can see all the way back to November of 2008, it was 50% of the market at that point where properties were distressed, and it's down below 1%. I think the number, what you had said earlier in that quote, was 0.55% is the actual number for distressed pre-foreclosure properties. It's an interesting discussion about distressed properties, but sometimes that is a source of less expensive properties on the market, and it's not there. That's a weird concept, though. Why real estate matters. This is the difference between the wealth that a homeowner has and what a renter has. And these are national statistics from the last, this is the 2022 survey. By the way, the source is on the bottom of all of it. This is the Fed themselves that have said this. So this is the Board of Governors of the Federal Reserve System and a 2022 survey. So it's actually higher than that now, obviously. But the difference between $10,000 and $400,000 in wealth. Economic impact of a typical sale of home. I thought this was interesting too. I thought I would throw this in. If we can get people into homes, then this is the economic impact, the average is 120,000 of the total economic impact. And that's a national statistic as well. Moving on, we have left some people behind, unfortunately, and not sure. These are, once again, national statistics. Home ownership races, race by race. At the top, that top line is white, and the line below that is Asian. Home ownership of Hispanic is indicated by a green line with the third from the top, and then Black and buyers and sellers are down at the bottom at 44%. I've seen some statistics when it comes to Native American home ownership. I don't have those statistics, unfortunately, but it's an issue in Arizona. If you look at the demographics of Arizona, 35% are Hispanic. Just the Navajo Nation actually makes up 5% of just the Navajo Nation makes up 5% of the population of Arizona. And we don't really talk about that a whole bunch about the effect on Native Americans, but I live in Cheshire. On my street, there's at least 5 Native American families living on the street that I live in. So it is an impact of how difficult it is for Native American buyers and sellers as well. Race of recent home buyers. This is pretty interesting, where you will see white and Caucasian buyers, home buyers, and then the right down below that of Black African Americans, Hispanic Latinos, and then Asian Pacific and others. Homeownership rate for, once again, unfortunately, I don't have it for Native Americans, but this is interesting. These are national statistics, and they have a tendency to speak about Black homeownership rates. But this is a 73, and you can see in Arizona right here, it's about 73%. It's a homeownership rate for white Americans. Moving on, this is Black Americans, about 41% in Arizona. Home buyer demographics by race as well. This is how it's broken out. Whether they're a multi-generational buyer, a single female buyer, and then also a first-time home buyer. And you can see where that comes out. And interesting is that 49% of Black and African Americans are first-time home buyers, and then also white and read the rest of it. Down payment source by race as well. It's also interesting what the impact is on what a family is able to help with. If you see over on the far right, you'll see that the Asian Pacific Islanders are much more prone to have home family help in purchasing. This is median net worth by a race from 1989 to 2022. And as you can see, and it's kind of what you would expect, $284,000 as opposed to $44,000. Generational warfare as well. The generation makes up a part of it. This is U.S. population by age in millions. There's multiple people in this room that are probably pretty happy that baby boomers are starting to go away. But this is how it comes out as where we are as part of the U.S. population. Baby boomers, of course, the interesting thing is how big the millennial generation is there. Home ownership rate for those that are under, this is an interesting graph because this is of home ownership rate under the age of 35. Which is very, very difficult to do nowadays. You don't really think about it that very much. But as you can see, the older boomers are on the far left, younger boomers there. Gen X had an easier time of obtaining homes, but look where the millennial generation, and then of course Gen Z is back behind that. This is the share of home buyers in each generation. I thought this was interesting as well. You still see baby boomers as a part of the home buying generation, and has actually increased over the last couple of years, which is, you wouldn't expect that to happen, but there's a huge pool of money that is being held by the baby boomer generation. Also, the ability to purchase how it spiked up. The millennials, the blue line, but has been decreasing. First-time home buyers. This is the number, part of the market, whereas you saw about 20 years ago, they were 50% of the market. At this point, it's risen a little bit, but you're looking at about 32% of the market. There's a demographic shift. This is interesting as well. When you see the great strides that single women have made in purchasing, but single men have not been able to match that. And unmarried couples, that has also risen quite a bit. You can kind of see the differences there, where married couples have really dropped off in being first-time home buyers. The others portion of that, the others are roommates. The biggest part of that, this was a really weird statistic. It's actually boomers. They are buying properties together. Older boomers are buying properties together because they can't afford healthcare. Is really what it comes down to. So, but interesting that men are not making strides when it comes to home ownership. And there's also a baby bust. This is the amount of people with children. We see this here locally, where your realtors will talk to you about how buyers or people moving to Flagstaff typically don't have children. And it's look how much it's dropped since 1985. Multi-generational home buyers, once again, this is trending upwards. I did that here myself in Flagstaff, and it's been trending upwards. So you'll get multi-generations buying properties. So that's that. This is the national sales statistics real quick. Total existing home sales have been dropping, spiked up. You can see the spike here right after COVID. And then it's been dropping off since. The median price of existing home sales, this is the national median prices, and I'm going to show you Arizona and then Flagstaff on top of that. So you're looking at, on the far right of that graph, that's December of 2023, where the national median, in real estate, we talk about the median and not the average. And the reason we don't talk about, because the median is at half, right? Half this direction, half that direction. And you'll see it in the Flagstaff market, that is closer to what an average home is. And I'm putting my fingers up for those of you online. A median home price is closer to what an average house is. So I'll explain it again here in a moment. This would be the median home price. By the way, okay, and then this is the change that we've seen, percent increase year over year. So this is last year. So you can see it started to drop, and then home prices are starting to increase again. And then this is total existing home sales percent change year over year, where you saw a strong beginning of 2023, and then that dropped down. Percentage change in sales from a year ago by price range is very sad. And it basically tells you that the people that can buy homes in the United States are at $750 and above. And that's where you're seeing huge strides. And the rest of it is a percent change in sale from a year ago. That look what dropped off. Up to the middle of that graph, that 250 to 500 range, I hate to say this, that's almost impossible in Flagstaff. And I think you guys know that. The rest of it, forget it. Just doesn't, it doesn't exist. It doesn't exist. Arizona, so this is real quick. This is from the Arizona Association of Realtors using a program called the Realtors Property Resources, kind of like the Realtors Zillow. And this will kind of give you some stats here. You can see this, the number of listings, this is all of the multiple listing services in Arizona. Number of listings is up, but it's down compared to the year before. Right here in the middle, you'll see the median sales price is down slightly. That's the 345. So I wanted to point out that the people that talk about Arizona being expensive, it's actually about $40,000 less expensive in Arizona than it is the rest of the nation. It's just not here, not in the nosebleed section of Flagstaff, of Arizona, right? But so that's kind of an interesting point there. Number of sales are also down on the right-hand side of that. You can see that's the number I was just pointing at. The interesting thing is this part right here, the average, this is the number of months it takes for a property to sell. 4 months, you'll see in Flagstaff, it's about half that. And then the basic price ranges that properties sell in, and the months of inventory are on the far right-hand side. So you're talking about a seller's market in Arizona up until about the $1 million point. And then it would be a buyer's market at that point. So a balance, let me go back to this. This 4 months, a balanced real estate market is 6 months. We're at about 2 months here. So, and I'll show you that. I have housing sales stats. So this is also from Realtors Property Resource. And what I called it, so just to define what I call the market, I call it single family homes, townhouses, and condos. It throws in apartments because it doesn't know the difference between a condo and an apartment. We don't typically sell apartments in Arizona, there's not on the news. But so this would not include manufactured mobile homes. There's a difference between those two as well. But you can see down in the lower left-hand corner, 2.2 months of inventory. And what that means is how long would the market take to absorb if we have no more properties coming on the market, how long would it take for everything to sell? And that's at 2.2 months. And it's a way to figure out how strong the market is. List price, the sales price is at about 97.4%. Median days on market is about 48 days. And then the median sold price, this number is a little bit different from what Karen told you, but it's similar. You're talking about 674, 750. And by the way, this was on a monthly basis. If you factor it over a full year, it's less than there, which is a good thing. And this is the median sold price in Flagstaff. That definition of Flagstaff from January 2019 to January 24. So her projection of what's going to happen over the next 5 years, I think is absolutely spot on. Interest rate, with the interest rates, with the drop of that, sales prices will increase. You can see some seasonal spikes and drops and all that kind of stuff, but typically, if you evened all that out, the sad part of it is that from January of 2019, the median sales price was about $350, and we thought that was a lot. And now we're double that. This is this is public records, so there's a difference. This would be just public records, so this is private sales and things that went through, did not go through the multiple listing services. It's 6025. You put all that together. I tell people median sales price is about 630 in Flagstaff. And if you look at it that way, a $630,000 house would be what you would be buying in an upper middle class neighborhood or a middle class neighborhood such as Cheshire, potentially even Fox Glen, parts of Elk Run, Ponderosa Trails, those kind of things. Ponderosa Trails was way up real fast, but kind of an entry level property there. This is months of supply of inventory in Flagstaff. As I said, we're at 2.2 months supply, and it did spike up. It's dropped multiple times. The worst time was right after COVID. We got down to about a half a month, 0.53, I think is what the number was. You can see that there between February 20 and September 20 and February 21. This is a different way of looking at it, a different program. And it had a medium sales price. If you throw in Belmont and Lens Park, you look at it a little bit more regionally. And then you also throw in manufactured and mobile homes, then the median sales price does pop now. It's a little less. So straight out of the MLS in 2023, so this is where I just went in and performed MLS searches to try to get an idea for all residential types. For Flagstaff, we had 1,163 sales. Average square feet is big. It's 19. This is average, not median. This is average. 1969. The average price per square foot is $384. And by the way, those of you that care about price per square foot, the smaller the house, the higher the price per square foot, the larger the house is typically less. Average sales price, shocking. So that's the average, is $780. Median sales price is $628. So that's, like I said, I tell people typically a median sales price, which will kind of give you a 3-bedroom, 2-bath, 2-car garage house in Cheshire. That's about what you'd be paying, on an average lot. If you just jump to single family out of that, this factors in townhouses, manufactured homes, condos, that kind of thing. So if you just went to single family, the median sales price is $735,500. Crazy. So the forecast. This is some of this is National Association of Realtors. You can see the annual all-time. This was from last November, and they did hit that. This is the least home sales that we've seen since 1995. New home sales are up in new construction, but is exactly what Karen was saying. Back from 2008 to 2011, where they stopped building, that very much affected the amount of properties we have on the market nationally and locally, and we are down thousands. We are low by thousands of homes just in Flagstaff, much less nationally and statewide. Single family housing starts. So this is construction starts. They have started to drop off exactly what Karen told me. And you can see the drop there. But contrary to what people will tell you, we started going into the Great Recession in the end of 2006, but by 2007, we were definitely cruising downwards. The bottom was 2011. Existing new inventory and new home inventory, you can see that's the existing inventory has risen, but new home inventory on a national basis is kind of staying flat here. Multi-family housing starts. There's a huge spike in multifamily housing starts. The unfortunate thing about multifamily is a lot of that is built to rent. And we've seen that here in Flagstaff. So much building is built to rent. People are starting to freak out in Arizona that we are becoming a renter's state. And it's unfortunate. This is a lot of what you see around Flagstaff. Rent growth is softening, however. So, and then Jackie can tell you all about this and other parts of the real estate market. But this is where rents are starting to climb. So that's the good part of all of these properties coming on the market, is the rents are starting to decline. First-time home buyer down payment as a percentage of the home price. This is kind of a basic graph here. You kind of see what their down payment is and what percentage of the home buyers are. First-time home buyers challenges. This is from the National Association of Realtors. So they do a home buyer, people that have bought a home, and they do a survey of them. Finding the right property is 61% of the challenges. And that's much higher here than that. But that is the pressure that they're feeling. Saving for a down payment is 38%. Understanding the process is 38%. Paperwork is 23%. And getting a mortgage and appraisal is actually, they find that to be a little bit less of a challenge on a national basis. I would say that that's much higher here locally because of the home prices and exactly what you're saying. So where we are going, So this is, I get to go to a lot of real estate conferences and then listen to very smart people talk about where we're going. So, so this is drilled down to, for us here in Flagstaff. Real estate market is not going to get crashed. So it's not. You'll see some clickbait online where people are saying the real estate market is going to collapse, or somebody said to me yesterday, well, that bubble's going to burst. I'm like, there's no bubble. There's no burst. When you don't have distressed properties, that's the bubble. Or an influx of inventory is a bubble. That's not going to happen. There is no inventory. There's nothing. Back in the day when we were talking, when in 2007, 2008, we were talking about shadow inventory. There isn't any. So the real estate market is not going to crash. It's going to increase. Interest rates will probably, I wrote this about 2 weeks ago, and now we know a little bit more, but I just thought I'd leave it there. Will remain high through June with gradual drops afterward. Have high in quotation marks, because when you look at it as grand scheme of things, 7% is not a terrible interest rate. It's not. If I was, the advice that I could give to you guys is, the market's actually better now for somebody trying to get their foot in the door than when all these pressures happen. When the interest rates drop, trust me, every investor in the state is going to start putting in multiple bids on properties, and it's going to get worse. These are worse. I'm sorry, guys. Flagstaff will continue to be highly desirable and maintain a strong economy. This is a good thing. It's a desirable place to live. This is why we live here. It's very desirable. And we do have a strong economy, as does the state, and it makes it desirable. So the pressure of people wanting to move here and wanting to live here is there as well. Flagstaff home prices are almost double the median sales price for the state, and that's going to continue. Our median sales prices are almost double. It's $300,000 more than that than the median in Arizona, and that's higher than the national rate. Compared to other mountain towns of the Intermountain West, Flagstaff's a bargain. We don't talk about that a whole bunch. Arizona is less expensive than any other state in the Intermountain West. Southwest, we'll say. We're not less expensive than Wyoming or whatever, but we're less expensive than New Mexico. We're less expensive than Colorado. We're less expensive than Utah. We're less expensive than Nevada, and forget about California. But if you were to compare us to other mountain towns, this is the pressure that we have. No matter what, we still have to work on these things, right? Probably continue pressure from second home buyers, and most will have cash. This is the truth. And as this is my 30th year in real estate, and I would say about 50% of my home buyers and sellers are second home buyers and sellers. And I think Jackie would probably say the exact same thing. She works with more investors than I do. I think Eric, you'd probably say the same thing. Right? Would you say the same thing when it comes to who? I think 30% of the structures in Coconino County are second homes. Investors too. It's the same thing. Investors will be here. Nothing in the way of affordable new construction ever. I don't mean to talk about politics, but that's the politics of our community. There will not be anything built that is affordable. It's just not going to happen. I'll move on. Rents will continue with a downward trend. That's a positive. At least it'll make it easier for people to at least live here. I said something very flip this morning. I said, when I was teaching a real estate class this morning, it's like, I really enjoy living indoors. So we're talking about shelter, talking about basic shelter. So huge pent-up demand from buyers waiting for interest rates to drop and inventory to increase. This is exactly what Karen was talking about. That's the demand. The shadow inventory is actually buyers. If, or more accurately, when interest rate drops into the 5s, demand and surge in prices are going to skyrocket. And this is the hard one. This is probably the cheapest real estate market you'll see in your lifetime. This is what economists are telling me, and the people that we're here to talk about. This is a difficult one to swallow. But the people, these people, what you are doing here, you can make a difference in the community, and thank you for doing that. That's it for me.
Yay. Thank you. So that's whole questions, probably the next meeting.
Oh,
Just-
that's my contact info if you need me.
Beautiful, and we share this life with everybody.
Yay. Thank you so much. I have 10 minutes. I'm gonna do it. So maybe.
You are gonna do
I'm not gonna talk fast enough. Okay, let's see how the clicker works. I'm going the wrong way. Is there?
Hold on, because I've got your presentation.
Okay. Apologize. I was very excited.
You were just ready to run.
I know. Yeah. It is so nice to talk after Gary and Karen, because you guys set the scene, you're experts in your industry, you paint the picture very well. So I do appreciate the information you shared, and I'm such a housing nerd, I can listen to housing statistics for hours and like just be riveted.
I can talk about 4 hours too. So
So it's love. So thank you so much. I'm gonna zip through this. You know me, I'm with Housing Solutions of Northern Arizona. We are the only HUD-approved housing counseling agency serving Coconino County. With me today too is Angela Coder, who is our Director of Housing Assistance Programs, another HUD-approved housing counselor in our agency, and she's the one that works directly every day with our potential first-time home buyers. So she gets to hear the stories, the struggles, the tears, and the dreams. So we do all sorts of things, and I do want to give a shout out to Karen and the other members of our Volunteer Housing Assistance Programs Committee, because I am by no means an expert in this field. We rely on those experts to help us when we're talking about approving down payment assistance, designing programs, providing expertise, and making sure people get into affordable lending, more affordable mortgages that they can maintain over time. So I want to talk to you about what we've seen in the last year. That's really what we were asked to do, who we're talking to, what their experience is, how we're helping. So in 2023 calendar year, we pulled the data. We provided pre-purchase housing counseling to 92 households interested in purchasing a first home in Flagstaff. It was more than that regionally, but we focused on Flagstaff alone. 85 households currently live in the greater Flagstaff area, so Flagstaff, Belmont, Williams, and 7 of those households lived in other parts of the state but wanted to move here. 65 households sought first-time pre-purchase housing counseling first in 2023, and 27 of them first came to us in 2022, and we still worked with them in 2023. The process isn't always quick, and there's many barriers, so sometimes folks have to work with us for a while to determine if homeownership is right or to overcome barriers to homeownership. Average household income of the folks we saw was $60,528. So right in line with that Flagstaff median income, maybe just a little lower. We are a nonprofit, so we tend to serve some lower incomes as well. Lowest income 17,000, highest income 176,000. So quite a range. We have programs that are income restricted and some that are employment restricted, and those employment ones are not income restricted. So we can serve households at higher incomes who might still qualify for down payment assistance. Average household income percentage, AMI percentage is 84%, and we gave you the breakdown. So you can see 24 households under 50% AMI, 40 between 50 and 80% AMI, 25 between 80 and 100, and 32 households over 100% of the area median income. Demographics, household size is another issue or interesting fact. So our average household size last year was 2.4 persons. 32 households are 1 person, 43 are 2 persons. That's actually our most common household size. And I'm going to give you some purchase scenarios here. And all 3 of our most recent purchases were 2 adults with 2 incomes, no children. So that whole children under 18 in the household being decreased, we're seeing that definitely in our demographics. Single parent households might also be in that person's household. Ethnicity and race. So I recognize Hispanic is ethnicity and everything else is race. We put them together for purposes of reporting to you guys today. But this is what we're seeing for folks that we're serving. And honestly, it's pretty reflective of our community demographics overall. So American Indian, 19%. That's about what we see, maybe even a little higher than Flagstaff demographics, Hispanic 17%, Caucasian 67.8%. And then outcomes. So I asked Angela, out of those 92 households, like, let's chunk them into different categories. Like, they bought a house, they didn't buy a house, they're working to buy a house. There's no way, heck, they're going to be able to buy a house, right? Like, the incomes are just too low or the debts are just too high. And so we had 12 households in the last year purchased with down payment assistance, 5 households purchased without our direct financial assistance, but they received education, counseling information. 26 households decided not to pursue homeownership. It wasn't right for them. They couldn't afford it. They moved out of town, whatever the case might be. 11 households, it's just not feasible. That's our designation. So we're looking at purchase power, debt, credit, and savings. And then we have 31 households right now who are preparing for homeownership to get ready, right? They're not shopping today, but they're improving savings, reducing debt, et cetera. And then 7 households who are out in the market working with wonderful partners to become mortgage pre-approval and working with realtors to find something that they can purchase. And then I wanted to give you some actual people who actually bought using actual assistance from our programs, because it's a little shocking to me. So I'll tell you the parts that shocked me. 2 adults, 2-person household incomes $94,000, AMIs at 111%. They've been here for 10 years. They purchased a $343,000 manufactured home in Christmas Tree Estate. So not terribly expensive, certainly not $670,000. There are some homes out there in the lower range, but certainly they get snapped up quickly. FHA 30-year loan, interest rate 7.75%. Yeah, it sounds terribly high, but that's what it is. The thing that gets me, I think, as somebody who bought my house however many years ago, is the monthly payment. So $2,470 a month. The clients have a debt to income ratio of 45% because they do have monthly debt. Their contribution was $17,000 and they received $40,000 in the second mortgage. So a lot of contribution of their savings and our savings to make that $343,000 purchase work. And I do want to point out, Karen's right. So for down payment assistance programs, lenders will go up to 55% debt to income ratio for desktop underwriting. This program is limited to 45% with some exceptions. So we're trying to make sure that folks can be sustainable in their home purchase with their mortgage rates and their existing current debt, but we are more conservative. We own that. And so, yes, sometimes lenders, they could have higher buying power if that debt to income ratio is 55%. 2 more adults, both employed full-time in Flagstaff. One works for a car dealership, dental office. They're at $88,000 a year. They've been here for 26 years. Purchase price $339,000 for a single-family home in Sunnyside. They got a conventional loan. Did get some seller credit in here, so there is some incentive for sellers to play to get homes sold. So they're at a 30% housing ratio. Their monthly payments $2,248, $70 a month in debt. They contributed $5,000, which is our minimum, to receive $40,000 in job down payments. And then this one is 2 full-time Flagstaff City of Flagstaff employees. There's no income limits on this program, so they're at 160% AMI. 27 years they've been in Flagstaff. Like, we are not helping people typically like just moved here yesterday. They've been here for a while. 30-year FHA loan, 7.75%. They could buy in Kachina Village because it's a city employer assisted housing program, so it's not confined to city limits. Monthly payments just over $3,000, $11,000 in their money and $20,000 in assistance. And then our impact. So 3 families in the last 2 weeks is amazing. It doesn't happen every day. Since 1999, we've helped 452 households purchase homes with direct down payment assistance in our community. 8.3 million in financial assistance has leveraged 69 million in first mortgage financing and 3.7 million in homebuyer contributions. 38% of our buyers are female-headed households. All first-time home buyers. Again, average AMI is 82% since inception, but you can see last fiscal year it was 118%. So we're having to help families with higher incomes to make it work to buy the home prices in our community. And then our average income last fiscal year of folks that received assistance was just over $86,000. What's working? So I think the interest remains high. The fact that we have 92 families coming to us for information and down payment assistance and assistance is a pretty significantly high demand. Households have support and tools to become purchase ready so they can work with housing counselors on improving credit, understanding the purchase price process, the language, all of that, saving for down payment. I will tell you, dual income households have additional buying power, and that's just a no-brainer. So we do see that they have an easier path to homeownership. We've seen significant increase in program interest since the assistance levels for CHAP and the employer assisted housing program were raised in the fall. $40,000 sounds a lot more attractive than $15,000, quite frankly. And so we're seeing buyers come in asking for help. The things that we can't control, it's the same thing, right? So we can't control the market. When interest rates go up, buying power goes down, and we don't get to decide what the rates are. This is the highest they've been since the Great Recession. Historically, they're not out of line. I get that. But when you could have had 4% 2 years ago and now it's 7.5%, you just go and stop. Inventory remains low, especially in lower price ranges. And then we see lower income households under 80% AMI, which is that federal definition of low income, struggle to afford purchase prices in our homes as their buying power is limited by income. The other thing I would say is back on that debt thing, because debt impacts buying power. And so when households come to us with higher debt loads, that also is a barrier for some households. And I think I did it. I haven't checked the time.
You did it.
Nailed it.
3 o'clock right now.
Yay, perfect. So I can put the little clicker down there. And then now go to my chair roles. Is that fine?
Yes.
Okay, all
You
right.
can skip all the other items.
Okay, all right, perfect. Okay, and so as I understand it now with the chair hat on, then we'll do questions and follow up at the next meeting. If people have questions, can they email them to you so they don't forget?
Yes.
Okay,
Any questions can be emailed to me. Actually, we'll just forget about the next meeting. So if
Okay.
you have any questions or comments, and then to me.
okay, so if there's questions or comments on any of the presentations, then we can send them to Adriana, and then will they get answered in the meantime for all of us to see, or will they get answered at the next meeting?
We'll make sure to get answers out to everybody.
Okay, perfect. Okay, and then do you want me to skip straight to adjournment as a recommendation since we're a minute over time?
A couple.
Or is there, okay, we're losing commissioners?
We lost 2.
We lost 2.
We lost 2. Can anybody else say, I think, can your comment be emailed out to the commissioners?
Oh, sure.
Staff update?
Yeah, I was just wondering if we need to get through the rest of the meeting before we adjourn, like just the items, or if we can just cut it off.
We can just cut it off.
Oh, okay.
Are you good with emailing it or? Okay.
Okay, so then staff updates will come in an email to the commission. And then if housing commissioners have updates, then they'll send those to you, Adriana.
Mhm.
Okay, and then our housing authority liaison is in here for updates. Okay, perfect. Thank you all for staying with us. I appreciate it so much. Thank you to our speakers today for their expertise and information. And at 3:01, I will adjourn the meeting. Does that work?
Yes.
Okay.
Thank you. Thank you, Devonna.